Well, hello members, LA here. This is the weekly review, December 18th, as we close out the year. And what do we got? We got the markets going up again, 3% on the NASDAQ, NDX basically same on the Russell. 1.25 on the S&P. We actually had bonds, and the dollar continues down. That dollar is coming to a point now where it's either going to bounce or we're going to get a faster move down. Which one we will see pretty soon. Looking at the year-to-date gains, S&P is a decent number, 15, and then you got these ridiculous numbers in the NASDAQ NDX. Of course, that's the FANG stocks that have driven that. Matter of fact, I saw a study just, I think it was yesterday or the day before, where something like 94% of the gain is in 4 stocks out of the S&P 500. It's pretty incredible. Gold up great on the year, as are the bonds. Dollar down 7%, and the dollar is potentially going to become an issue. We'll have to watch it closely. If we look back at what we had seen with those bullish ABCD structures, right? When most of them have been hit already. We have this one that last week we commented is like it's basically done. It's got 0.08% to go. You're definitely there, right? You're like 3 points away. That probably gets hit this week and finish it off. But the main thing I wanted to bring this up for is that it's bullish when you keep seeing new ABCD structures form and then fire. And that's what we have. We have a new one here that points another, percent up basically, or it was at the time that it created. Still got the weekly out there, another 2% up, and I suspect if this becomes real, we'll see more of these form and fire as well. Looking at the other side of it is you really have to be careful here not to just get sucked in and complacent, because there are divergences that are taking place and have been taking place. So look back at this, and this again cap weighted. This is the daily. When price goes up on the S&P, but the number of bullish stocks decline, that's a divergence, right? And that's telling you that you're getting underlying weakness even though you don't see it in price. And so, looking back at this one, you saw, it continue, you get a dip, it continues even higher, and then eventually you get a big fall, all right? And that was back in that March time frame. If you look over here, this is back in the, I think that was July time frame here. Maybe it was August actually, but same idea, right? You get a high here on the green arrow, right, and a high on the price, and the prices go higher, yet you get divergence, all right, and then you get a bigger dip. We're at that place again, right? We just barely got a higher high on the S&P. Yet we've got divergence here. Yeah, we can push this higher, which is probably what should happen right into the end of the year, another couple weeks. Whereas this probably is not going to see this turn. I doubt we get that kind of action that takes a bunch of stocks and make them bullish again. And so you're going to see probably a decline here, maybe a little bump up, but it's going to be divergent. And that again is a warning sign. You got to focus on where we're going, right? It's almost like when you're playing soccer or anything, and football, and you want to throw the ball or kick the ball. You got to kick it to where they're going, not where they are. And it's kind of the same way with the markets, right? We got to focus on where we're going and what do we do when things play out. So, our ideal is like, where are we going? What's our plan, right? And then execute that plan. And so, if I look at where we're probably going, it's probably a number of things that can go wrong to take this market down. My expectations, we're going to see some sort of a 5, 7, 10, 12% drop in a relatively fast manner at some point. And that point looks more and more like it'd be sometime after the new year. But I suspect we're going to see that. And you could think of many reasons, right? This vaccine rollout could be a disappointment. The new strain of COVID that's shutting down Great Britain, and you're getting flights canceled to Great Britain and from Great Britain now from most of the European countries. You're starting to see that new virulent, more contagious version of COVID spreading now to other countries, Denmark, etc., that could be a real issue, right? But that could end up with another wave of shutdowns pretty much across the world. You could have a surprise Democratic win of the Senate to where the power of balance no longer is, one party having control of the Senate and one party having control of the other two branches. You could have all three in one, and that may be enough to upset the market. We got earnings going to come up again in another month. That could be disappointments. It could be the dollar. Dollar's coming to a key point now. If it doesn't bounce and starts to escalate, I always say that when you see escalation of price in the currencies, usually that's not a good thing for the equity market. So there's a lot of stuff out there, but there's always a lot of stuff out there, right? So we can't get hung up on this. We're more than likely going to see prices hang higher here into the new year. That's typically what happens, especially in a bullish year like we have. But it's anyone's guess after equities start to trade the new year. And we do have, it looks like, as I write this morning, Sunday morning, it looks like we got another $1 trillion coming in fiscal stimulus, some more freed money. And my question is kind of what I've been saying the last couple of weeks, is like, is this already baked in? Have we already risen on the expectation and we're going to sell the news? How do we navigate, what I expect to be the coming cross currents, right? We don't want to get ahead of ourselves until we see evidence that there's something. And I keep harping on this because it's important. Until we see something that tells us that this is over, right, and that larger setback is coming, we got to stay with what it is. And the way you can see it is you can see it on the different time frames. If you look at the time frames, and this is the 30-minute, this is the daily, this is the weekly, this is the monthly, what's going to happen to affect this is going to happen over here first, right? We're going to see the 30-minute show us weakness before the daily, and the daily before the weekly, and the weekly before the monthly. They're either simultaneous or they're before. And so I expect that we will see here the weakness, and this is where we got to keep watching. And we don't want to see just one ABCD structure and fire to the downside. We want to see multiples. We want to see it happen 2 or 3 times. And if we see that, right, then we're probably going to see some effect over here on the daily if that's what starts to take place. And matter of fact, before this happens, you're going to see bullish structures form and either fire or fail to fire, and then we see a bearish one fire and complete. And so that's what we're looking for. We're going to drill down, and that's what we've been talking about. We want to drill down to the lower time frames, and we want to see those give us evidence that the turn is here, where on the larger perspective we see, like the graph we just looked at back here, right? We see this telling us it's going to happen. We see sentiment telling us it's probably going to happen. We see there's a number of things telling us that something is probably going to take place. And so we want to see confirmation that that really is starting to happen. The lower time frames, as I said, are going to affect the higher ones. We're going to have to recognize that we're assuming the first hard retrace is going to get bought. And there's no reason not to assume that. We're too bullish, right? They're going to buy that first dip. They always do. The issue will be what it always is. So you're going up, right? You're finding a way to go up. And then eventually you get a hard push. They're going to buy this. They always do, right? It's going to be this bounce that's the key. Do we get enough on this bounce to, with respect to like bearish retest regens to tell us that this is going to go make new highs, or does it start to roll over itself? And when you get this situation, that's when you can get the faster move, right? And so maybe this ends up being a 3% decline, get a bounce, it doesn't make new highs, fails, and then all of a sudden you get a 6%, 7% decline over here. We want to avoid this. We don't want to be involved in that. And matter of fact, if this starts to roll, right, this doesn't have to stop at 3. It could go 5 or 6 to start with. And we want to use our 30-minute time frames to warn us that this is becoming more serious, right? We need to start taking action. That's what we're looking for. So what do we do? How do we manage that, right? And the options as I see them are either on that first hard retrace, right? And I'm talking about either we start down hard and we get 5 or 6% on that first one, or we go down 3 and get the bounce and then start down hard. It's this that we want to protect against, and we've got to decide what to do about it. You can mostly ignore it. So if it's at 2 or 3%, doesn't look that serious right off the bat, and that will show up in the 30 minutes where we'll have an ABCD down. Maybe we'll get a bullish one up and then another bearish one down. We'll start to see this stuff start to happen, and that's usually some sort of a decline that's slower and it's going to give us a smaller decline. If we see that kind of action, then we just let it go, and then we watch that bounce and we see what it looks like on the daily chart. And if that in fact doesn't have the characteristics we want to start putting our plan into action, and that is to sell all or part of our non-core positions. And when I say non-core, I'm talking about things that I'm trying to hold for weeks and months, as core. And so those things that are short term, I probably want to start taking action against those and sell some of them or all of them. Maybe I start to hedge my core positions. Maybe I just let it run. Or maybe I take and pull my trailing stops up. But you have to realize if you do that, and it really does turn out to be the larger position or the larger plunge, right, you're going to make a lot less profits. And so maybe you do half of it. Maybe you take half of these out and let the other half run with the stops as a hedge. All the while, you're going to keep monitoring your watch list, right? Because you want to be able to buy. Remember, as this thing rolls over, they're going to buy the first dip, right? And if that first dip ends up being, 6-7%, or if the failed bounce gives us the, 10-11% down, and then this starts to run, and then we got a bearish retest regen that we get over, right? Telling us that what was down is probably sideways. We want to start buying whatever's on our watch list. And so we want to monitor our watch list and keep this up to date so that we're ready to implement whatever it is we're going to implement. It may be that you don't even care about a watch list. You're going to go back into your core positions even heavier. That may be your strategy. You just need a strategy, right? You need to look at what you have and decide how you're going to deal with it. Those 30-minute signals will give us the idea on the way down. They'll also give us the idea on the way up, as well as daily, weekly, or actually just daily probably, bearish retest regens, right? And if we get over those, then we want to time some sort of an entry back in. That's kind of the plan. 30-minute time frames, what I'm talking about, you can see those, all right? I put those out every morning before the market opens. Generally, I'm, 15, 20 minutes before the market opens, sometimes right around when the market's going to open. Depends on how quickly I get to it. But I put in these lines, right? These are ABCD structures. I don't advertise it that way, but that's what they are. And we're looking for projections, right? We think it's going to get to the bottom of this range. These are ranges. I use these for my trading intraday, and you can do the same. This is S&P 500, and I'm basically looking at it and saying, okay, where do I think the range is going to be today? In this case, I think the range in this day was going to be in this area right here, right? If it was trend, right, then trend could take it up that high. Trend could take it down this low. You can see that if this were to break trend, you probably would maybe want to try to run with it intraday because there's a lot more here to go. Over here, if it breaks into trend area on the downside, there's probably not a lot there. You probably don't want to push your luck if you're trying to short this thing intraday. Same thing on the upside. You'll see ABCD structures there. And matter of fact, this was the 11th, this is 14th. So this day, we were projecting down to 36.77. And as you can see, it looks like we probably got there, right, or almost there. And then we reversed. And we started heading back up. And if we were to follow this out, these all got hit because we're way up here now at new highs. And so ABCD structures this past week have been forming, firing, and fulfilling. That's bullish. As long as it's bullish, we don't want to do anything different than to ride this market higher, and that's what we've been trying to do. Where's the worst case? It's still where we looked at last time, still down in here. That would be, to me, the worst case. You could even argue that now, you should see support come in up here, but we don't have enough yet to tell us that for sure. So first support may be in this area, and I didn't draw. I used the last week's chart. I didn't draw in this week's action. We're up here, but the more likely support is still down in this area. That's how far we could go. There's the weekly again from last last week, and the same thing I'm showing the monthly. What's my conclusions here? We know eventually things are going to change. From my work, though, we know that we're nearing that point, but we're not there, and we don't have any evidence that it's going to happen yet. And the best gains can come near the end, right? So we don't want to get ahead of ourselves here. We want to wait this out and make as much as we can. We just monitor it very closely, right? And you go through your stocks, prepare, just like I was talking about before. Decide what you're going to hold and what you're not. Get a list of things you want to buy on weakness, and identify where you're going to buy those things. And this I will definitely be helping you on, right? Because I'll be doing this for myself. I'll be trying to figure out, once we start to turn, where those spots are that I want to try and put money back to work. Last week it was kind of a split between best and most likely scenario. We basically went flat last week. This next week, I think what's going to happen is what always happens in the year. Your ranges are going to get a lot tighter, right, between where price actually is and can go. And more than likely, I would think that we're going to just drift up a little bit. We could get a little bit higher. That's best case. Worst case, you just come back into this congestion area probably. And there's the details there. I think this market's getting close. I also know that historically this time of the year you just grind higher. Volumes tail off and price just finds a way to gravitate towards a higher number. So I would expect that. Beginning of the year, though, be ready potentially for something to change. That's it. Merry Christmas to everybody, and I'll see you next time. Stay safe, folks. Take care.